One indicator that investors pay attention to is called the yield curve. What exactly is the yield curve, and more importantly, what can it tell us about the broader economy? Well, to understand the concept better, imagine that a good friend of yours, Jen, is looking to start a pie-making business. And so Jen comes to you asking for a loan. And the reason she does that is because she needs to buy supplies. She needs money for a rolling pin and flour, apples, and an oven. And so you agree that you'll lend her some money, and in return, she agrees that she'll pay you that back in 1 year at 4% interest. But let's say that she wanted 2 years to pay you back. In that case, you'd likely charge her a higher interest rate because you'd want to be compensated for the extra risk that you might take on, the risk that maybe her company falters or she can't pay you back. Plus, this is a longer amount of time that you forego being able to invest in something better if you find a better opportunity. So over 2 years, you might charge her an interest rate of 4.25%. And over 3 years, this might be 4.5%. So if you were to plot these on a graph, it would look something like this. 1 year, 4%, 2 years, 4.25, 3 years, 4.5. Now this chart is what we call the yield curve. It's the relationship between the yield, that is the interest rate you're getting back from a bond, and the bond's maturity, that is how long until it gets paid back. But see, generally when we talk about the yield curve, we're not talking about the loan terms between you and Jen. We're talking about the loan terms between you and the federal government. Remember, the federal government borrows money from people like you and me every day to pay for roads, bridges, law enforcement salaries, and so forth. And it does this by issuing bonds. So what can the yield curve actually tell us? Well, it's important to realize that the shape of the yield curve changes every day because as people buy and sell bonds, this changes their prices and their yields. And we explain why that's the case in another video. So let's go over two basic shapes of the yield curve. The first is a steep yield curve. Let's say that 20 years from now, you think that the economy is going to be in great shape, that companies are going to be doing well, a lot of people will have jobs, profits will be up. Well, if that were the case, would you want to stash your money away in a bond that only paid you 4% per year for 20 years? Probably not. You'd want something that has more upside. So you might invest in stocks or commodities or maybe even real estate. You want something more aggressive. And if enough people think like you do, then 20-year bonds would have to yield a lot more than 4%, probably something closer to, say, 6 or 7% before people find them attractive. And so for this reason, a steep yield curve often indicates that people expect that over the long term, the economy is going to improve quite a bit. It also indicates that in the short term, yields are low. In other words, the Federal Reserve, which is the nation's central bank, has set a policy making it easy for people to borrow money because it wants to stimulate the economy. So for this reason, a steep curve often signifies longer-term optimism along with shorter-term stimulus from the Fed. In other words, it's trying to stimulate the economy by keeping interest rates low. Now, an inverted yield curve, which is fairly uncommon, is the opposite. This is when short-term bonds yield more than long-term ones. So let's say 20 years from now, you think that the economy is going to be in really bad shape, that unemployment will be high, companies will be struggling, and so forth. Well, if that's the case, you might be perfectly content with a bond that's only paying you 3% per year for 20 years. And so for this reason, an inverted yield curve is kind of a vote of no confidence in the economy's future. It means that the outlook is bleaker. At the same time, this scenario also suggests that the Federal Reserve has raised interest rates to relatively high levels in the short term, and it's probably done this because it thinks that the economy is too strong in the here and now, and inflation could come as a result. And so it set a policy that's made it more difficult for people to borrow to kind of slow down the economy. So for this reason, an inverted yield curve often signifies longer-term pessimism, shorter-term overheating, and also a coming recession. The last 6 times that the yield curve inverted, an economic recession occurred shortly thereafter. But see, instead of trying to remember all the investor psychology that's at play behind the yield curve, it might be helpful to just imagine a simple metaphor. Think of the yield curve as a ramp at the end of a ski slope, and the economy is the skier. So if you've got a steep yield curve, the economy is likely to soar. It's likely to do very well. It'll be a fun ride. But see, if the yield curve is instead inverted, it means the economy is less likely to get air. In fact, it's grounded for now. So the yield curve is not infallible as an indicator. Nothing is. But at the very least, it offers a sense of investors' expectations for the economy both now and 30 years out.